But then what's your take on what Jerome Powell said today, that the Fed was prepared to increase the pace of rate hikes and that the terminal rate is likely going to be higher than previously anticipated? A lot of people are reading that as a sign that they're going to go faster.
So he created space today to move by 50 basis points on the next hike. You know, they'd come into this year pretty clearly telegraphing that 25 basis points was going to be the per meeting rate hike for the early part of the year, and then in some sense, taking the foot off the brake and seeing where the economy lands. And in fairness to the Fed, the interest rate tool as a means of controlling inflation it's like having surgery with a dull knife. It is a really difficult tool to get the job done with because you hit the housing sector, you hit the manufacturing sector, you hit parts of the economy that have a very high sensitivity to interest rates. And you tend to leave the rest of the economy relatively untouched. So the Fed doesn't have as much impact with their tool as you might hope. And although they've raised rates considerably, it's not clear how long the lag effects are for the impact. And once the impact starts to play out, how damaging that impact is. So they're in uncharted territory. It's a difficult place to be. If I could tell one thing to the chairman, I would tell him to say less. I would just write a message. We're going to put the inflation genie back in the bottle. We're going to do what it takes to make that happen, and we're going to raise rates consistently until we see very clear evidence that we put this behind us. Because every time they take the foot off the brake or the market perceives they're taking the foot off the brake and the job's not done, they make their work even harder. And at the same time, remember, they're impacting in a very, very harsh way a very small part of the economy. And that's really tough for those businesses that live in that part of the economy.